Hello and welcome to my channel Making Money and Finance. I have a new video for you today. How can you start investing as a beginner? Before I begin, I want you to hit the like button, leave a comment, and subscribe to our channel so that you are the first to know when we upload a new video. And if you find our video useful, please share it with your friends and family. Although setting aside money for savings is the initial stage in the process of accumulating wealth, putting those savings to work in the form of investment is often the initial step in expanding that wealth. Although stocks are typically the first thing that comes to people's minds when they think of investing, you may put your money into other things as well, such as real estate, cryptocurrency, art, or pretty much anything else. This video will cover the fundamentals of several financial assets, such as stocks, bonds, mutual funds, exchange-traded funds, and certificates of deposit. Because each of them comes with a different level of risk and reward, the one that is appropriate for you will primarily depend on the objectives you wish to accomplish, the time frame you are willing to commit, and the level of risk you are willing to take. Your concerns can be addressed by a financial counselor, who can also assist you in formulating a strategy for the future of your finances. Why investing is such an essential activity. The majority of us are not going to become wealthy by putting our money into a savings account. To achieve that level of success, you would need to work hard over a long period of time and put away the majority of your earnings every year. Rather, we need our money to make more money, which is one way of explaining what investing is. We need to invest our money so that we may generate more money. When you make investments, you put yourself in a position to benefit from compound interest. The operation is as follows. You put $10,000 into investments, and each year, those investments earn a return of 8%. If nothing changes, the account balance will increase to $10,800 by the end of the next year, representing an increase of $800. Your account balance will increase by $864, bringing the grand total to $11,664 when another year has passed with an increase of 8%. In the year after that, the profit would be $933.12, bringing the total to $12,597.12. The next year, the account would see earnings of $1,007.77, bringing the grand total to $13,604.89. As you can see, the power of compound interest may help turn even relatively little amounts of savings into a substantial nest egg over time. It is arguably the easiest option for many people to acquire access to raising the total amount they have saved for retirement. And the earlier you start investing, the more you stand to gain from the magic of compound interest. 4 areas of investment for those just starting off. Because there is such a wide variety of options available to you when it comes to investing your money, many people who are just starting out may feel completely overwhelmed. Those who aren't as experienced in the world of investing will do best to look for areas that have a lengthy history of being relatively stable, and that can be held for a significant amount of time in order to generate the kind of return they're hoping for. These are the best kinds of investments. We have developed a list that comprises 4 of the finest possible choices that correspond to these criteria. 1. Stocks. Shares of a corporation, often known as stocks or equities, can be purchased with the intention of increasing their value before being sold. Dividends are one more method that owning stocks can result in financial gain. A portion of the company's earnings per share, typically distributed on a quarterly basis but sometimes more frequently, is distributed to shareholders in accordance with a predetermined schedule. However, other well-established businesses, such as AT&T, ExxonMobil, and Coca-Cola, do pay dividends. There are certain businesses that do not pay dividends. These stocks often offer dividends of up to $1 per share, which has the potential to result in considerable and speedy growth for your portfolio. Despite the fact that stocks have the potential for significant gains, investing in them also comes with significant risk. This occurs relatively frequently in the stock market due to the rapid increase or decrease in value that a company may experience. On the flip side, the potential for high returns is the cost of doing business. In addition, having a diversified portfolio of equities might assist in mitigating the risk of incurring losses in a particular sector. 2. Mutual funds and ETFs. Both exchange-traded funds, ETFs, and mutual funds are comparable, in the sense that they both contain a variety of equities and/or bonds in their portfolios. Some concentrate on a particular industry, for example, large-cap corporations, while others follow the performance of particular indexes. Because they are designed to provide diversification, they carry a lower level of risk than individual equities due to the fact that your money is automatically divided across a variety of investments. However, exchange-traded funds, ETFs, and mutual funds do not operate exactly the same way. The most important of these is the manner in which they trade. When you purchase a mutual fund, you are not truly aware of the price that you are paying for the fund itself. This is because the price is reset each night, taking into account the most recent closing prices of the stocks in the fund. On the other hand, exchange-traded funds, ETFs, are traded just like stocks, which means that you can observe the price as it varies during the trading day. You, on the other hand, have the ability to determine the maximum price that you are willing to spend in advance. These securities do not have any required minimums. Nevertheless, the brokerage firm that you choose may charge a commission for each trade. The S&P 500 and the Dow Jones Industrial Average are two examples of well-known indexes that are followed by many exchange-traded funds, ETFs. Others follow groups of stocks that are concentrated in specific industries, such as the medical field, the technological sector, or the agricultural sector. 3. Securities with a fixed income. The term fixed income securities encompasses a wide range of financial instruments, including government bonds issued by the United States Treasury, corporate bonds, municipal bonds, and certificates of deposit, CDs. When thinking about them, it is easier to conceive of them as loans that are given to the government, corporations, state agencies, and banks, respectively. You make an agreement with them to lend them your money for a specified amount of time, at the conclusion of which they will give you both your original money and the interest accrued on it. In most cases, the interest rate will be higher if the term is stretched out over a longer length of time. However, there are times when this is not the case. Although the opportunities for profit are limited, these investments are considered to have a high level of security. There is no denying that certain corporate bonds carry a greater degree of danger than others. In point of fact, the interest rate that a company is charged will be greater if it is considered a riskier investment due to the instability of the company's financial situation. Bonds are susceptible to price declines for another reason. They can be resold on secondary markets. This occurs when there is an abrupt increase in the rates. People want to sell their bonds so that they can earn a greater interest rate on their new investments. If you can keep your bonds until they mature, you won't suffer any financial loss from them. However, you run the risk of incurring a financial loss if you decide to sell them. Certificates of deposit are generally considered to be the most secure of all the fixed income instruments that have been discussed here. It refers to funds that you agree to leave in banks undisturbed for a period of time ranging from 6 months to 6 years. Because they are products offered by banks, they are protected against losses of up to $250,000 by the Federal Deposit Insurance Corporation, FDIC. You will therefore get your money back, up to a maximum of $250,000, no matter what the outcome of the situation with the bank is. In the event that interest rates surge to a level that is higher than what you are currently earning, you have the option to withdraw your money early in exchange for a penalty that is normally equivalent to 3 to 6 months worth of interest. 4. Real estate. Real estate is a form of investment that a lot people are familiar with than others types. You can choose to purchase either a second house or an investment property with the money you have saved up. Both residential and commercial properties can be rented out to generate income to offset some or all of the costs associated with maintaining the investment property over the course of the year. You can have a compounding effect on your overall monthly revenue by renting out various houses. This can help you reach your financial goals. Holding on to a piece of real estate in the hopes of making a profit by selling it for more money than you paid for it in the future is the easiest way for first-timers to invest in real estate. You can generate income by renting out numerous properties. When you want to sell the property in the future, you can see a nice profit gain if you invested in it as an asset for a number of years and chose the location of the property wisely. There is a widespread notion that purchasing one's own home is the safest and most secure initial investment one can make. What you need to keep in mind when planning your investment strategy. Every possible approach to investing can be placed somewhere on a spectrum that ranges from low return and low risk to high return and high risk. The unpleasant reality is that there are neither many nor any investments that combine high returns with minimal levels of risk. This is the primary reason why more people do not invest in the stock market. Therefore, people who are looking for the biggest return spend the majority of their money in stocks. If, on the other hand, you fear taking risks or are unwilling to invest in stocks and shares, you should probably stick to exchange-traded funds, ETFs, mutual funds, or bonds. Because of this deliberate choice, you are opening yourself up to the chance of receiving returns that are lower than those you would receive if you invested solely in stocks. Diversification is a key guideline to adhere to, regardless of the specifics of your intended financial outcomes. When you diversify your portfolio, you spread your investments across a number of different areas of the market in order to protect yourself from sudden drops in value. This could mean purchasing domestic as well as foreign securities, as well as combining high-risk and low-risk investments in proportions that are tailored to your individual level of comfort with risk. Your investment horizon should play a role in the decision you make on whether to pursue a high-risk investment plan with a high potential return or its alternative. The older you are and the further away you are from retirement, the more risk you can afford to take, according to conventional wisdom. This means that when you are in your 20s and can afford to chase returns, you should have a portfolio that is heavily weighted towards stocks. Then, even if a recession hits when you're in your 30s and causes your portfolio to suffer, you'll still have plenty of time to make up for those losses before you retire. According to the same line of reasoning, the closer you are getting to the time when you will be retiring, the more attention you should pay to maintaining your gains and avoiding taking on too much risk. If you reach the age of 67 with a large amount of money in your portfolio, enough to sustain you for the next 30 years even if there are ups and downs in the market, then you are in a position to switch to bonds since you can afford to do so. However, some individuals make this transition much too quickly, causing them to miss out on the gains that they require to maintain the growth of their investments and make it through retirement. Due to the fact that people are living longer in retirement and, as a result, need more income during retirement, financial experts are hesitating to recommend that anyone decrease their exposure to equity investments too soon. How you can get started in the investing market. The vast majority of us just do not have the time to investigate dozens of different securities, and even if we had, we probably would not be able to do so in an effective manner. Access to information and assistance with investing can be gained through a variety of channels, each of which offers its own advantages and disadvantages. The most common and popular option is to work with a brokerage firm. These services come with associated fees, which you should research in order to identify the ones that are the least expensive. If you are uncomfortable with the thought of investing on your own, speaking with a financial counselor about your options is likely to be a wise decision. These folks typically have experience incorporating long-term financial plans into a portfolio and can help you with this process. In addition to this, they are able to assist with a wide variety of other services associated with financial planning, including retirement planning, planning for education funds, tax planning, estate planning, insurance planning, budgeting, and planning for charitable gifts. What is the minimum amount that I need to start investing? Before beginning to invest, there is no ideal sum of money to have on hand, unless there is a required minimum sum that must be met in order to acquire the investment option of your choice, like real estate. The fact of the matter is that a lot of individuals put off making new investments because they want to wait for the ideal time or until they have the ideal amount of money to do so. However, waiting merely delays any potential returns on the money you already have invested. Investing has never been more convenient, and a large part of the credit goes to the IT sector. You may begin with as little as a few $100s, and then you can just gradually add more money to your overall investment over the course of time. It is important to keep in mind that using larger brokerages may require a minimum investment of $1,000 or more. However, this should not prevent you from getting started if you are prepared to do so. Investing of some kind will almost certainly be required if the goal is to transform a relatively low salary into an income sufficient to maintain a comfortable standard of living during retirement. A 401k plan provides many workers with access to investment opportunities provided by their employers. If this describes you, it is imperative that you make the most of the educational tools that are made available to you by your employer. In general, before investing your hard-earned money, you should do some research beforehand. If you learned anything from this video, please share it with a friend, press the like button, and subscribe below if you haven't already. Thank you so much for watching.